Dylan and Raphael here again to talk about risk and finance and all the things you love to hear about. Last month, we got deep into recasting risk as uncertainty. Something that Raphael has had more experience with than I, because anything bad is just a good thing reversed, right? And life is uncertain. And uncertainty can happen in both directions. A healthy business needs to consider the possibility that it might not go according to plan. Now, this was a bit academic, I feel. And I think in the main question that I got was, okay, how, coming out of that, how can we practically dip our toe in the water with modeling uncertainty in a business? Raphael has agreed. You are ready to help make this fast and easy for us. We're going to walk through some tools, some tech that has come up in the last couple of years that makes this a lot easier than it was in mid 2000s with, Excel 6.
I mean, the first thing I'd say, well, yes, but the first thing I'd say is that you can still quantitatively analyze risk with Excel or even Google Sheets. It's just a different form of analysis. It's not maybe as sophisticated or as nuanced as other tools out there. Mm-hmm.
So, still possible. You can also probably still do it with Fortran, I imagine. But it has gotten easier, is what you're saying.
Yes, absolutely. And also, not just easier, but also easier to understand and easier to implement.
And presumably communicate to people who may not have as...
Yeah, so when I say easier to understand, I mean the whole communication cycle. So understand as someone who's looking at it, also understand as someone who is being presented it by someone else. The whole piece, Mm-hmm.
Awesome.
Yeah. Okay. It also comes down to the way people model as well. A lot of people do best sort of middle, average, and worst case scenario. I fundamentally think that that's a pretty, I mean, it's a sort of slapdash approach to it that's sort of not really realistic. So that's a whole other conversation, maybe for another time.
Right. I hesitate to tell you this, but a lot of the time, even those data points can be pretty sophisticated.
I mean, I would say that it's trying to create an abstraction on top of something that's already quite abstract for people, which actually makes your life harder rather than make it simpler. I won't go too far down that rabbit hole, but I generally think that keeping it to operational uncertainty or sort of something around sort of realistic sort of uncertainty is always better than just saying this is a best case scenario, this is a worst case scenario. We're somewhere in the middle, in that vague sort of gap between the two. Sure. Let's discuss that another time.
Okay, so let me cast myself into the position of someone who's maybe somewhat interested in trying this out.
Mm-hmm.
I'm good at Excel, let's say.
Mm-hmm. Sure.
Because I am. I can play that role pretty well. And I'm frustrated. Excel is mostly deterministic. I have a random function. And so if I'm good at math, I can introduce some randomness into my formulas. But mostly I'm doing math from, starting with column A and working my way that way, adding things up, multiplying things together, selecting, based on certain filters, maybe.
I've never thought of using the random function in Excel for uncertainty. Um, it's just like blown open a whole new idea, sort of a range of ideas for me. Although I'm not sure how
Well,
practical it is because you can't define behavior apart
yeah.
from
Well, that's how.
minimum maximum. So
Right.
I
Well,
actually know
that's
what
how
the
it
likelihood.
worked
Yeah.
back in. There's this quip. I guess I'll paint a picture of how I perceive it used to be done. The state of the art in like 2003 in modeling uncertainty was mostly Wall Street analysts. And they would have these enormous 10,000, 30,000 row Excel workbooks.
Sure.
And they would run Monte Carlos
Yeah.
on what if this stock price did this? What if this commodity did this? And they would run these suckers, and Excel would crank and crank and crank, and entire business models for boutique hedge funds relied on these very calculated, very intense calculations with many rows, and they were all powered by the rand function to give you, and then you'd map it into a normal distribution or something.
Actually,
So in every
yeah.
cell, it would
Yeah.
reference rand.
Yeah. So the thing with Rand is that in that particular use case, it's not a bad idea to use because finance is supposed to be is supposed to work on stochastic probabilities. So it's
Right.
not supposed to be driven by historical data. Actually, that's a massive quibble that I have with the finance industry, in that it's based on math that is, by definition, not supposed to sort of rely on historical data, and yet finance obviously does rely on historical data and looking at where things of the stock prices have been before projecting where they're going to go. So fundamentally, I think that there's a flaw in the way that we think about finance. It's just our best guess because no one's come up with something better. But in that particular case, Rand actually works because you're not supposed to know whether it's supposed to go up and down, and there's not meant to be any behavior. So you just say it's between this and that, and it will give you anything. And so that actually works. But what I was
I
talking
have,
about,
folks, this is not a result that I would have expected to have converted Raphael into kind of getting in line with the mid 2003
no,
way of.
I'm not in line with them. I'm saying that fundamentally, the theory behind using Rand in that use case works, but it's based on flawed theory in the first place. So
Yeah,
it's not foundation that I would build a house on,
sure.
unfortunately. But what
But
I
these
was
were
actually yeah, but this is what people
difficult,
were doing. Yeah,
right?
this is
Like you people would people in the business would treat this like scripture.
Yeah,
And the
because,
person who
but also
wrote it,
like reality being driven by theory, and then theory being
yeah,
driven by reality. So it's kind of self fulfilling in some way. But the underlying theory of it is fundamentally flawed. It's I know. So I thought sort of I picked up on this literally in my first class at a sort of masters in finance course. I was like, hold on a second, that's not how random functions. That's not how random theory works. You can't say that in 1 second and then this the next second. It'd be
yeah.
coherent, but anyway,
But
yeah,
these results were hard to communicate, right?
they're impossible to
Like
communicate.
this was the way they did it. You had this big spreadsheet, and then you got
Yeah,
the answers at the end. And the
yeah,
savant was like the priest who interpreted the oracular leaves that the
yeah,
spreadsheet ended up with, and interpret it and say, buy pork bellies at 2,700,
yeah,
and the firm would do it.
yeah. And
And
it's literally that, and you're being paid huge amounts of money to say that, even because no one really understands fundamentally what's going on behind it. And you
yeah,
could be wrong a million times, but you only need to be right once, and people will tell you that it's that you're a savant because that's sort of confirmation bias
yeah,
talking.
it's
There's
happened to
a
me.
lot of that going.
And I think this culture made like it worked a lot of the time. I mean, it was better than
It worked until it didn't work. That's the problem.
Other mechanisms of pork belly future, purchasing strategies at the time. But I think it made general managers nervous because it felt inaccessible. They didn't get it. They just knew magic answers sometimes came out of this big old spreadsheet. And I feel like that created a culture of like uncertainty is not for regular people. And because you needed this savant to interpret it. And you couldn't understand most of the things they were saying. And when I talk to you, it feels like that reality is changing, that uncertainty is starting to get intuitive, that it doesn't require a savant anymore. It doesn't require Excel anymore.
So
what
a couple of things
do you need to get started? Like, what are the base table stakes for starting to model uncertainty in your business?
So I come from a physics background. So on one side, I want to say an understanding of sort of some scientific grounding is always helpful. But at the same time, I want to try and make this digestible to people, obviously, who haven't got a scientific background, which is going to be 95% of people that listen or hear what I say. I prefer to think of uncertainty as trying to understand behavior, sort of likelihoods of behavior, but not in numerical terms necessarily. You can think of it even in qualitative terms, in terms of is something is, I don't know. So you've got a piece of machinery. You own a factory, for example. You've got a piece of machinery. You know that it's got a sort of downtime of, I don't know, 0.8%. You know that it could be up to 1%, and you know that it could potentially be down to 0%. It could be running at 100% of the time. Most likely, it's around 0.8%. There, you've already defined a probability distribution in your mind. That's the kind of rationale that I try to get people to think about in sort of their business. So, in your business, in sort of cyber, there is a 0.0001% chance of this particular sort of risk occurring. It could be 0%, that's highly, highly unlikely, or it could be 0.001, so one zero less, for example, but it's close to 3 0 ones. So there again, you're creating a distribution of behavior if you're thinking about it mathematically, but you can also think about it just qualitatively. Essentially, what you've created there is a beta distribution with a likelihood at one end and a tail at the extreme. And so, or you could think of it as, in terms of, if we're talking about finance, it's plus or minus 5% either way, and it's an equal distribution. It's a Gaussian or a triangle distribution, or it's evenly spread across. It could be anything, and this is where Rand comes in.
The old Rand
It could
function.
be anything. Yeah, it could be anything between 0 or -1 and 1, for example. So,
right.
Let
me. Okay, there were some technical words for those
I tried
not
to be
familiar with
too
Gaussian beta distributions or
well, to be fair, I defined what they were, but I did try to define them in non-scientific terms first.
Hills in your head. Just imagine hills that have different slopes and pointing bits and stuff. So what I'm getting from you is there has to be some kind of quantitative literacy. People have to be used to thinking numbers wise, at least within the right order of magnitude. They know the difference between 1 in 100 and 1 in 1,000.
Right. But
Or
if they don't have at least that basic level of quantitative understanding,
mhm.
then I maybe they're not in the right position to be like as a career job.
Yeah.
They're not doing the right thing, because the people that are thinking about what we're talking about, sort of decision makers and stuff like that, they need numerical fluency, literacy anyway, because you need to be able to read a balance sheet, you need to be able to read financial statements to some degree, because you're talking to your investors, to your board of directors, or whatever. You need to be
Right.
able to make judgment calls on how to budget, what to forecast in terms of revenue, profitability, all these things. So if you don't have that, if you're able to do that, you should be able to do this. The problem is not
Mhm.
necessarily in understanding the maths so much as getting over the hurdle that you pointed out, that people associate risk with bad things because of the way that sort of society has conditioned us to think about risk. And actually, getting back to your initial sort of opening about what risk is, and that it's a sort of a good thing that's reversed, I would say the reverse of that is that risk is just an opportunity.
Yeah.
It's
To not
uncertainty
suck.
both ways. It could be both ways. It could Uncertainty or risk
Uh-huh.
is basically just not knowing exactly where you're going in the future. You could think of your revenue as going up in a straight line like this. The reality is that once you reach the present day, it could go down a little bit, or it could go up a little bit. That is the range of uncertainty. So uncertainty is not immediately negative. It's not,
Mhm.
it's bad or the opposite of good. It's just unknown. So it could be good and it could be bad. And it's up to you to make it the way you want it to be by trying to gain some control and understanding around it. So and when you try to dig down into that and say, okay, why could my revenues drop? Because we could lose this big client. Okay, so maybe we should diversify a portfolio and not rely on three big clients, for example. So it's an opportunity to become resilient. So
Right.
risk should not be associated, it is unfortunately in society associated with negative things. And this is why I talk about uncertainty rather than risk. Risk shouldn't be associated as a negative thing. It should be associated as just an opportunity to make oneself more resilient to change, more resilient to
Mhm.
failure. The problem is that culturally, that's just not where we are.
Yeah. All right. So I'm a
Back to the topic.
I'm a uncertainty skeptic. I'm dipping my toe in the water.
Right.
Minimally, it sounds like I need some mathematical literacy and basic finance. Probably being able to read a P&L is probably a good stand-in for that. Is that
It's a good
necessary for
equivalent.
all of the audience that I would need to that's going
I
to
would
be
say it
consuming my
helps.
insights?
I would say it helps. It doesn't need to be. I mean, that was just an example. I mean, I was on a call with a client today about marketing spending, for example, and we were talking about attribution levels. And even in that, there's uncertainty because you don't know where to attribute when someone clicks on your website or buys your product, because you don't know if it's because they saw something on a Google ad or because they saw something on a Facebook link or whatever. And you're putting ads out everywhere. So you don't know exactly what was the trigger for them to sign up. So that is also uncertainty. So uncertainty can be in anything. You could be a marketing analyst. It could be a business analyst. It could be a I don't know supply chain sort of operations person. It doesn't really matter. But I think most jobs in work today, unless you're like a pure creative, in which case you're not really worrying about the sort of the budgeting and the forecasting, all that kind of stuff. Most jobs require some kind of numerical literacy today, because like even if you're not the business owner above you or the manager above you is going to ask you for estimates about things, about what your budget is, what the numbers are, what you think your revenues are going to be, how
Mhm.
much do you need to, where you're going to spend the money. If it's in marketing, for example, you're going to spend it in this country, that country, and sort of on Facebook ads or LinkedIn or whatever. So more and more people will need numerical literacy anyway as their day to day. And if you don't need it, you're probably not going to be worrying about this anyway. So there's like on a scale of 1 to 10 of things you need to do to get to 10, this is not something that you'd be worrying about if you're sort of at zero in numerical literacy.
Okay.
I think. I mean, that's my take on it. Maybe I'm being a bit, I don't know. So,
Tune in and light us up if you would like to provide some counterexamples. But we'll take it for
I
now.
can't think.
I
I
think
can't
you're
think of
mostly
any
right. People
examples.
do have some sort of numerical literacy, especially in like America. You got credit card statements, you got bills, you
Sure.
got credit scores. People are measuring the crap out of you, and you better get with
Yeah.
the program
Yeah.
or it's going to
We're becoming
be
a
painful.
more data-driven society anyway. So
Yeah,
yeah,
right.
this is just another iteration, another vector on that.
Yeah, making it work for you. All right.
Yeah.
So, some sort of numerical intuition, literacy.
Yeah.
Where do people start? What would be like if this seems like a good way, and I'm tired of like sitting in my director's meeting and people are just mouthing off about, what if and this and that. I'm kind of imagining that meeting in Big where they're presenting the Transformers-ish
I
thing
think
and it
we've all
falls
had.
apart
Yeah,
and Tom Hanks is
I think
sitting
we've all
there and they're
had
like, oh, what if it was a
some.
bug? And like nobody knows what they're talking about. I see a better way. Where do I start?
Well, where do you start? Ironically, I think is with Excel and so Google Sheets. So if you can, I mean, they're not pretty, but sort of 99% of the world knows how to use it to some degree, knows how to use Excel and Google Sheets, or I should say Google Sheets. So that I would say that's where you should start, but that's certainly not where you should finish. Because in Excel, you could do stuff like you could create scenario models. You could create some drop down lists to say, okay, this is sort of what the different scenarios could be.
Right.
You could create some
Okay.
nice little
Here,
tables sort of with sort of.
I got an example
different.
for you that probably applies to everybody in America, and the rest of the world is probably going to sound aghast because that seems to be the theme this decade. Every year, I created a scenario model for which health insurance plan I should buy. Health insurance is expensive here, and so I put in the cost that I would pay in premiums every year, and then I said, okay, if my family, if these things happened, if my son broke his arm and my wife had this much of medical bills and I had this much of medical bills and I got bit by a bat and whatever, how much would that cost under this plan? And so I'd like add it up and use the rules, like after this amount, then it's 80%.
Sure. Yeah.
And after this amount, it's like free. How much would it cost me at the end of the year? And then for the second plan, how much would it cost me at the end of the year? And then the third plan, how much would it cost me at the end of the year? And then I do that with some different scenarios. Maybe I get $50,000 of medical debt all by myself because I'm just that talented. What about that scenario? Which plan is cheapest then? All in.
Yeah.
And what I discovered is a lot of the time,
so expensive.
One plan was cheaper for like all the way across the scenarios. Or maybe very frequently, one plan was significantly cheaper if nothing bad happened or if like everybody got cancer. But in the middle, something else did better. But it wasn't by much. It was like maybe choosing that plan, I'd be ahead $300. This seems like the sort of problem that could get you started, that you could, is what you're trying to describe, right?
I'm actually not entirely sure I define that as a risk assessment so much as a market assessment.
Sure.
Because you're not saying what is the likelihood of me being bitten by a bat or whatever. You're saying, okay, given this series of conditions, and you're doing a couple of different scenarios, and you're saying, sort of, if nothing happens, if worse, so I mean, there is a little bit of risk in there, but you're not really. That's more of a market analysis to me than a risk analysis. because you're more. I mean, no, because it's a different approach.
Sure.
It's
But
not
I'm
wrong. It's just it's a different thing that you're trying to do. But it is putting you in the mindset of comparing different scenarios, which is where I was going
mhm.
with
Yeah.
Excel and Google Sheets. Is that with those tools, you can create scenarios, however ugly and clunky they are.
Mhm.
You can create scenarios and then do some analysis. But there are a lot of other tools these days that are much more intuitive for that kind of thing. And I would say that if you're just getting started, sure, use Excel and Google Sheets, but after a certain point, you probably want to use something that's if you're doing it more rather than just getting started as an individual, but more as a professional thing. And you want to save time, you want to make it more digestible, easier to communicate. Then you want to probably use something else, and that something else. There are a lot of different tools.
So
I'm partial, as I think I've mentioned, to Causal, but there's other stuff like Runway. There's a tool that I used to use called Current. It really depends on what your budget is and what your sort of literacy is in terms of modeling. A lot of different factors come in.
so I would say, okay, fine. You're calling it a market analysis. Oh, and by the way, thanks, John.
Yeah,
John, who
yeah,
has taught many classes in resiliency, and man, I've shamelessly stolen from him. Points out that the concept we're probably looking for is called numeracy. And
yes,
QRA presumably is quantitative risk
quantitative
analysis.
risk assessment.
For
Yeah,
those hip to the
assessment and
jive.
analysis. Yeah.
Thanks,
Yeah,
John.
I mean, I 100% agree. I was saying, so if you're just getting started somewhere, just at the sort of just getting sort of started with the whole process, that's sort of what my minimum would be. But obviously, I'm coming from stuff. As I started out by saying, I've come from having done that undergrad in physics,
Sure.
so I'm not at that stage.
Too fancy.
So,
Okay, so I would like to more fully explain the difference. So, to me, what I described with the insurance and the stuff, that was a threat model. But where it fell down is that I had to do the likelihood assessment myself. What are the odds of this set of costs applying to my family? This set of costs. And often I think of them as like all equal. And man, there are so many possibilities. How am I supposed to know?
clearly not. Yeah.
Yeah, I can't do a stochastic
Yeah.
sampling, right? And that's where Excel usually fails people. If you want to include the likelihood distribution of, like, I could say, it's pretty unlikely that I'm going to get $0 in medical costs. There's a peak around 10,000 and then 30,000 or something, and but it's this smoothness of how much I'm likely to incur in a typical year.
Yeah.
And you want to combine that with a different curve, or maybe somebody else's curve.
Multiple different curves.
Yeah. And think.
So this is where Excel falls over.
This is where Excel falls over.
Point,
and I feel like this is a, I'm going to get your goat, a quantum leap, a discrete jump from that kind of thinking where you have to kind of do your own probability analysis to getting the tool to do all that stuff for you.
Yeah. So just to step back a little bit, you could do some of that in Excel if you had the patience for it.
I would say, okay, let's just
it's
one
annoying,
thing out of the way.
But you could.
You can do anything in Excel. People have like programmed Doom in Excel. It is Turing complete.
Sure.
It's
I mean,
not good at it.
Yeah. It's not good at it. I'm saying that's what I was getting at, is that if you're doing it as a one-off or even once a year off as an individual, sure. And you could probably do enough with Excel that you'd be satisfied, or you won't want to spend too much extra time learning a new piece of software to be able to do it any other way. This is why I was saying that if you're doing this on a professional basis, and time or efficiency is key,
Mm-hmm.
that's where other tools become more relevant. So, and they all have different benefits and downsides. Oh, actually, yeah. I mean,
Okay.
I'd argue Causal almost doesn't have any downsides that I've found so far, but they've all got benefits and they've all got
Sure.
downsides depending on what your comfort zone are and so on.
So walk us through some of them. Like,
Right.
do you want to
So
start with causal because
yeah,
you're a fan?
yeah. I'll talk about Causal first because I'm a fan, but also I know it best because I've been using it daily for almost
Mm-hmm.
5 years now.
Mm-hmm.
So Causal is an immensely powerful modeling tool. It's marketed as an FP&A tool, but it's actually really just a general purpose modeling tool that allows you, apart from do a whole load of stuff, obviously, that you can do in Excel, but much better and faster. The key thing in terms of risk analysis the two key things it allows you to do really well is one, define probability distributions and present them really easily, but also build multiple probability distributions, which is what the second piece that you were saying, and have logic connecting those different distributions to then see what the aggregate impact is. So, to give an example, piece of work I'm working on at the moment is I'm building a risk survey, essentially a sustainable financial sustainability model for higher education, and I'm building uncertainty projections around every line item on the balance sheet for a university, and each of those line items has got a different probability distribution at each time increment, depending on historical behavior,
Right.
factors going forward, etc. And so there's a different distribution at each time increment on about 500 different lines on the balance sheet, and Causal can handle all of that and then give me sort of the overall distribution of everything happening simultaneously. And I've never seen any other tool do that, barring this other thing called Current, which I've not actually tested in years, but at the time I could have done it. But it's also an enterprise level tool. I can't just dip my toes with that. You have to pay quite a big
Sure.
license fee to use that one. So
Let me
Causal,
say that in
yeah,
a different way. In a way, because I have also used causal.
yeah,
Causal is good for people who are already good at Excel and they don't want to worry about the uncertainty thing. But for each source kind of data, you can set uncertainty. And then when you're doing a formula or you're doing calculations with that data, it automatically propagates the uncertainty for you. So for instance, you're doing, and it's great at predictions and propagations. That's kind of how it's bent towards.
yeah. But
You
it's
might
also got a
say
lot of other stuff that's really, really bad. It's
the interest
really, really powerful in
rate
it.
of, I don't know, variable adjustable rate mortgages might be anywhere from 1.4% to 10.2%. It'll probably hover around 6 year over year for the next 20 years. We're pretty comfortable with that looking at the last 50. And it will try different things. And when it multiplies maybe the variability of your property appreciating or various insurance things happening, it will kind of automatically take care of that. So if you're used to working in Excel and you have these discrete deterministic ideas and you're going to create a formula that multiplies this, adds this, whatever, you can do those where each one has an uncertainty and a distribution, and it magically makes all your uncertainty pop out in the final answer too.
Yeah, there's additional stuff they can do around uncertainty, which I think will tickle your fancy. So you can also define uncertainties using historical data. So, for example, I took macroeconomic data, so census data actually. I took census data from the US to track household income over time by different buckets, so of income levels. and I imported those into causal, and then built a probability distribution of what the overall household income looked like. Well, actually, the household spend based on household income looked like over time. And then I used that along with a bunch of other things, which I won't go into detail on, to then build out a credit card interest model to say, if these people spend this amount of money on this credit card and there is a sort of behavioral probability that they're going to pay or not pay their interest at the end of the month, and that goes on for say 6 months, for example, before the credit card company declares some sort of essentially as a sort of a churn. This is how much interest the credit card company can earn. So you can import historical data, build a probability distribution around that, have that forecasting forward and saying, okay, I think, and I was doing this during the first Trump presidency. So I had the higher end earners and the low end earners going, sort of essentially growing, and the sort of the middle middle economy households disappearing essentially over 4 years. You can build those probability distributions based on history, build forecasts off of that, and then factor in a whole load of other, say, behavioral other drivers into the model to then create a view on something that seems completely tangential and unrelated. Another way that I've used it is to forecast client profiles. So a company that has multiple products, for example, or has multiple types of client based on, I don't know, different tiers, different regions, or different packages that they buy. Then a company wants to know what their average value is of a client. They can say, okay, this percentage of clients has this many seats, for example. This other percentage of clients has this many seats, and so on. So you can build out your distribution like that, or you could say, this is what my ideal is. How close am I to reality with my historical data? And then say, what do I need to do to get to where I want to be? Or I can say, if my target revenue is this, then what is the sort of range of number of clients that I need based on this distribution? So you can use it in lots of different ways. You just need to be creative. I could literally ream off for like an hour on all the different types of models that I've built using uncertainties and causal. I mean, there's the sky is the limit. Your imagination is you can go as far as your imagination can go with this because it's that powerful.
This webinar brought to you by
Causal. I am not sponsored by Causal or anything like that. I just think it's a fantastic tool.
Yeah. Here I got something it's not good at though.
Go on.
It is so good at time-based data, projecting out what might happen as if there's a consistent or predictable uncertainty or like a probability per year of something happening, and there's like a dependency of what happened the previous year. It's so good at that. But if you want to build a model that that isn't time-based, right? Because a lot of my models,
do that. Maybe you didn't.
I've tried.
There's an option for. Did you know that there's an option to remove time completely from the model?
Yes, I'm telling you right now, Raphael. It was tough.
Well, maybe you need to do a little bit of a tutorial with me. John's asked a question, by the way.
Yeah. So, John, I would, being maybe less of a fanboy, I want to answer this question.
Go on.
It is like Excel, and it magically handles the uncertainty for you. Yes.
I think that does a disservice.
Fine. It's pretty magical. I think that's its superpower, and so it does pretty good visualization, and you can assign different.
It gets a lot better. It's gone through a lot of iterations recently. The visualization is unbelievable today.
Okay, cool. What it does in terms of like how it does that uncertainty propagation is Monte Carlo in the background. And so your answers are sometimes a little goofy. You put in equals 8, and if you put in a distribution and you rerun it, it's like mean is 8.01.
Yeah,
And
but that's the nature of Monte Carlo.
right, because it's a little
And
bit
the
uncertain.
more obviously the more probability distributions in it, the
Hmm.
more granular, or the less granular, I should say, it becomes, because it's having to run so many that it optimizes for performance. So there are limits.
Right.
But I mean, like I said, I'm building a model at the moment which has got something like 500 variables. All of them have got
Yes.
probability distributions on them at every time period for 9 years, and I'm still not hitting the ceiling. So
Right. Right. So I'm trying to make it real easy to understand. It is Excel. You got the columns, different ideas per column, maybe gross margin, maybe cost of goods sold, maybe shrinkage, ideas per column. You're gonna muck with your columns and do math with them. But each column, think of it as you get to also assign it a distribution. And to Raphael's point, you can generate a distribution or compare that distribution that you think it is to historical data.
yeah,
Uh,
you can
so I
also
think
have the
it's,
distribution driven by historical data.
yeah, you could,
Um,
yeah.
yeah,
I would say it takes the fiddliness out of uncertainty. It makes it visual, right? Like
of course. Yeah,
you can very nearly draw a density function as your or a probability density function, and it'll just take care of it, like an arbitrary one. Maybe it starts at 0 and it goes up to 8 and back down, whatever you want. Almost it'll represent that and just kind of magically propagate it to whatever answers you need. It is very time based. I'm sticking my guns here.
well,
You gotta prove me
the
wrong.
it is designed for forecasting, so
Yes.
inherently it's meant to be time based. But like I said, it's got an option in it to remove time completely from it. I've never used it because I've never had a use case for it, but I know that it
Right.
exists.
Yeah. And a lot of the modeling I do is not time based, right? The
Yeah. Well,
probability
like,
that
yeah,
you
but you
get,
could, those probabilities that you've shown me, you could have them being time based. In fact, I
sure.
think I talked to you
And
about
I
it at one point when
I
you showed
could
it to me.
build, yes, didn't work. All right. Give us
Need
the
more time
next one.
working on it with me. The next one I think would be Ramp.
Hmm.
So Ramp is a relatively new one. I think it was put out to the public about I've lost track of time. It's probably about 9 months, maybe a year ago. I was in talks with the founder for about a year before that, a year and a half before that. So I got to see a little bit of it beforehand. It's not dissimilar to causal, but it hasn't got the probability distribution function out of it. It focuses more on the scenario analysis. So you can create really interesting visuals where sort of you sort of have your forecast, and then you can literally drag that forecast up or down at different points, and the model will then tell you how it, if I remember correctly, or you can draw really cool visualization in it, which I haven't had a chance to play with yet, but I really want to. Where essentially you can create Gantt charts that are linked to your model. So each variable can be a Gantt chart essentially with a whole load of metadata on it. So you could say, for example, this project has got this budget and it's going to be between this date and this date and so on. And it will visualize a Gantt chart for you. And then you can toggle things on the Gantt chart and it changes the assumptions behind it. And similarly, if you then create a forecast of what it is or your product development is or whatever, those change with it. And then you can automatically save scenarios so you can see what the range is and it shows like a shaded area between them. So that's another way that you could do risk analysis.
Hmm.
It's less quantitative in the sense that you're not building a probability distribution, but it is quantitative in the way that you are saying these are sort of my maximum minima. You're just not building the behavior behind it. So it's closer to Excel in that respect, but it's a lot more visual and a lot easier to play around with and set up scenarios and not have to have different versions and sort of naming conventions and all that kind of thing. So it's sort
Yeah.
of
Oh
somewhere
man.
between the two. I mean, just the Gantt function on it, it gets me all excited from an operational perspective. So being able to
Yeah.
optimize your operations around that is really, really cool.
Yeah. I mean, to be able to define dependencies, and if a particular project has, this step is going to take between this amount of time and this amount of time, project
Mm-hmm.
managers that's been paining them. I've read books
Yeah.
about how to do that.
Yeah.
And
Well, this allows you to quantify that really, really easily.
Mhm.
So it's another fantastic tool for that in that respect. Actually, I hesitate to mention this, but I've got my own niggle with causal, but it's more of a design thing, and it's because I use it at such a level that it becomes
You're going to
irritating.
get us desponsored. Is this
I
the
just wanted
same
to be balanced. I didn't want to say causal is
demonetized?
perfect.
Okay.
Yeah. So
Rafa,
that's
is
RAM
this
for
the
me.
same? Is this the same ramp that offers a free financial management backend?
I don't think so. I think it's called RAM. Hold on, let me just get the URL out. I'll put it in the chat if
Okay.
I can.
So,
I think it's called ramp.finance or something like that. Hold on.
there is
Yeah,
a
I get
company.
confused as well. It's
We'll get
no, sorry, it's not Ramp. It's Runway. Sorry, I always mix the two names up. It's Runway, not Ramp.
Okay,
Yeah, my
guys,
apologies.
get your name and stick together. So I was
Yeah,
curious because Ramp is a really cool platform itself. Um,
yeah,
we recommend it a lot. It allows you to modernize operational finance in a really powerful, really cheap way. You can API it. You can write code to control an alert on financial events. You can get really granular. You can look for anomalies. It is so cool, and it's free. They make money off of like the credit card transactions you charge using their platform, and but they do require you to have like 75K in the bank, uh,
right.
like a minimum. Which,
Yeah,
uh, um, so John, this is like the best question to me, and I'm I know someone who's written a book about it, and you also know that someone who's written a book about it. And I'm pretty sure it's the same person. Um, Visualizing uncertainty is hard, but I rely a lot on density maps. So like the fade in, fade out effect. Maybe you're projecting this over time or something, but
is this a probability distribution when you say density map? Because maybe it's different
I'm
vernacular, but I'm not familiar with that expression.
I am describing the visual effect of like where the where the where it's more likely, it's more like the color is more intense.
Oh, so it's actually color based as well as sort of
Sure.
it's a peaking.
So you've
Okay.
there's also a different model which is topographical. So it's like if it's higher, it's greener, and if it's lower, it's redder or something like that. I'm not as much of a fan of that. I find it overwhelms people. But if you choose a color to describe gross margin, maybe orange is your gross margin, and blue is your I don't know, like operating costs or something like that. I've had a lot of luck overlaying those different colors and using like darker blue to indicate the most likely place that this is going to be. And a lot of tools including I've even done it with Power BI, as gross as that may sound. I'm not sure Causal allows that.
No, it doesn't.
But
That
you can,
the closest I can think of having done something like that for me would be going back to university in MATLAB.
yeah, yeah.
Yeah, but from a
I
professional perspective, to throw my hat in on this question,
Mhm.
I would say, so I use a combination of two things. I use the probability distribution, but on a sliding scale, so you can look at each time increment and see what the movement is of the distribution in parallel with the just a regular sort of time sort of line chart, but sometimes bar chart, but mostly line chart, where I can actually see maximum, minima, median. Actually, I can define whether I want it to be the mode, the median, or anything else. I can also define whether I want it to be 95%, 90%, 80%, and so on. So I can actually
Mhm.
see the range as a
Mhm.
shaded area on the chart. And that is really
Mhm.
helpful from a business perspective because I'm trying to
Mhm.
explain it to people who don't
Yeah.
necessarily understand risk. And what I really want to show them is essentially what is the likelihood that you're going to hit zero on your runway on your cash, for example,
Yeah.
or whatever. So having something that sort of visceral for them really works very well. So that's sort of
I'll
my bread and butter these days.
I'll address the elephant in the room, which is like box and whisker plots have been used for a a century in describing risk. And like if you know how to read them, they work. But if you need
Yeah,
to communicate uncertainty in a hurry to someone who is not doing that every day, and
yeah.
like I don't think they're
It's a
worth it.
lot less sort of visually appealing. I mean, essentially, what I'm ironically, I went, but when I think about it, what I was describing is essentially a line chart version of a box and whisker plot,
Yeah.
but it just looks nice and it's easier to understand.
hmm I use now a visualization tool called Superset, which is like
Okay.
uh, a, a open source. It's like what Power BI and wishes it could be when it grew up. It is way
Knocking on Barbie.
cool. Yeah, I mean, Power BI is great. It's like the blue light special of data visualization tools. It's fine. It's the middle shelf uh, generic version of the thing you're buying. So, but a superset is really cool, and once you get more sophisticated, um, you want to get more sophisticated about visually presenting risk or uncertainty or interesting numerical distributions and combinations and scenarios. It gives you a lot more levers and dials, which and I think that's important because often the visual intuitiveness goes a long, long way in communicating. Like that's
This is why I like causal so much because it's
yeah.
so easy to communicate.
The the
Yeah,
default graphs that come out of the box are
yeah,
great. Like you put in
fantastic.
your
Yeah,
model, you switch over to dashboard,
people
and like
understand them, and
you
that's what you need. You need people
it's
to
ready to
understand them.
present. hmm
Yeah, yeah.
Okay.
I mean, you could do some sophisticated stuff, but it will go over people's heads, and that's not the, and that sort of ruins the whole
Waste.
point of what you're trying to do. Yeah,
Yeah.
it's a lost opportunity. So I try to keep it as basic as possible.
Sure.
Yeah,
Okay. Next one. We talked about
right.
causal, runway.
So yeah, so
John, I haven't done R in 2 decades. Don't
yeah,
don't come around here and recommend R in a public place. Next, you'll be
yeah.
recommending LawTech and Fortran 77. Okay.
I would. So this is going back to when I started my professional career. Well, I should say my career professional anyway. Is a tool called Current. I haven't used it in more than a decade, but I've been in touch with the company on and off for years. I help them on some. So we do some consultations and stuff like that. The tool is, I would say, an enterprise version of causal, but it also has what I was talking about with the Gantt stuff. It also has that from Runway. It's an immensely powerful tool.
Mm-hmm.
Can do some to give you a sort of this is 15 years ago when I first did. I took a model for a client that was a huge industry analysis model. It was literally something like 400 Excel spreadsheets with a macro on top of it that was sort of building them out and then churning the numbers and getting literally one data point out of these 400 models and then using that as on a separate Excel form analysis. It took about, I think it was 7 or 8 hours to compute one variable. Like literally, if you wanted to make a flex on the model, you hit the button go at 4 o'clock at night, and you see what the result was. And if you made a mistake, you'd lose another 24 hours. So I rebuilt that huge behemoth of a model in Current 15 years ago. So like it's like immensely more powerful these days than it was then. And it did all of that plus an additional piece of analysis that I did on top. Instead of putting one piece of data from all the models, it took literally the entire discounted cash flow model and built an industry level discounted cash flow model on top of it. Did all of that and crunched the numbers in 7 minutes flat. So insanely powerful computations. And you can build distributions in it. You can do your visual elements with the Gantt charts. I've actually played with it. They've got a demo. It was built for the mining industry, so they've got some really cool mining models where you can say, okay, what is like the carbon impact of this capex planning that you've got, and sort of what can you afford to do and keep underneath. They've got some really cool stuff, but you can do that and use Gantt charts to sort of schedule different capex projects and to say how long they're going to be and how much money you're going to put in them and stuff like that. So they've got some really cool visualizations. They've even got like little videos in it that you can sort of optimize, like process optimization around refineries and stuff. So for me, that's like if you had the money to spend something and like your budget is significant and but you're actually sort of making massive changes, like you're sort of handling like multi-billion-dollar sort of contracts or sort of revenues and stuff like that. For me, like Current is the tool to use. I mean, I've never seen anything quite as impressive as what they've got. It's just that it costs a bit of a buck to get it to use.
Sure.
Yeah.
Okay. So we got 5 modeling tools, 2 of which are mostly the same.
Yeah.
We've got Excel and Google Sheets, mostly the same. They theoretically can do anything. We've got
within
but
some
our
degrees.
best at scenario discrete models. We've got causal, which is good, really intuitive, and the defaults make it easy. Like it comes out looking pretty good with if you, even without any customization, it's almost ready to present to your board. Then we've got
Runway, not Ramp.
Not Ramp.
Yes.
Ramp is fun too. Ramp's awesome.
Yeah, but it's not a modeling
but
tool.
It's not Runway. It's not a we've got Runway, which is really good at uncertainty, especially when you're thinking about dependencies. That Gantt chart, maybe project planning, handling that for you.
And also scenario analysis is really good for scenario analysis as well.
Okay.
Not to say that causal is also very good for scenario analysis. It's actually the kind of interesting thing. You can do scenario analysis with distributions, or you can do scenario analysis. You can do risk analysis by scenario analysis or with distributions. But with scenario analysis, you're sort of limited to, unless you're going to do like a million different scenarios, you're limited to, this is where most people go with the best, worst, and median case scenarios. So that's the failure, if you will, of that approach for me. But yeah, so but that is another thing that you could do.
And the last one, remind me.
Current. Yeah, sorry, the
Current.
name is I don't ask me where they got the name from. It used to be called Carbon.
Is it spelled like current, like an ocean current?
Querent.
Oh my
It's,
goodness.
for some reason they removed the U. It's a South African thing, so maybe it's
Yeah,
an interpretation of a dialect. I'm not sure, but
sure.
it went through a couple of naming changes even when I was using it 15 years ago, and they've sort of seemed to have settled on Current for the last 10 years or
Okay.
so. Mm-hmm.
Current with a Q. Google probably knows
QE,
what you're talking
yeah,
about.
yeah,
If you want to
and
Google it.
it's owned by a company called Business Science Corporation (BSC), if I remember correctly.
Okay. Sounds like a
Yeah,
TLA. All right. So these are great tools. The advantage, I would say, the practical advantage of Causal and Runway is they're cloud products, and you can sign up for probably 50 or something a month or somewhere in there to
yeah,
go run a bunch of models.
yeah.
It's
I
not going to
think
break the
yeah,
bank.
yeah, that's the thing. So causal, in terms of licensing, causal
Thanks.
is thanks, John. Causal, I think there's a freemium version, which is relatively limited but allows you to play around with it. And then its subscription model is, I think it's $250 for the sort of starter. Then
Mm-hmm.
I think it's
Okay.
somewhere around the 1,000 mark.
Pretty, still
Runway
pretty
is
cheap.
straight to 1,000,
Sure.
but you get a lot with it.
Under 1,000 per month for some
Yeah,
pretty advanced modeling. And if you want to go learn this yourself, you can go create some models
yeah,
for
and they've got a
free.
great template library as well.
Yeah.
Yeah.
Is Runway priced kind of in an equivalent monthly model?
So they've got a monthly subscription, but it's they've just got one price plan. It's
Hmm.
$1,000 a month, if I remember correctly.
Okay. So
Yeah,
they're for serious people.
yeah. They just don't like causals have gone through a couple of iterations on their pricing. They've gone with like different tiers, and you can have bolt-ons and stuff like that. Runways decided to just go with a sort of one price for everyone, where you just get everything with it. If I remember
Yeah.
correctly,
Sure.
it's been a while since I've spoken to their sales team. But that was the impression I got last time I spoke to them.
Sure. Okay.
Yeah,
So
different approaches and strategies
yeah, and then current
is a lot
is
more expensive.
probably like the Oracle model of pricing, where if you have to ask, it's well, no, the Oracle model is
I don't quote me on this, but get the sense that we're talking about a few. It's more of an annual license rather than a monthly, which gives
sure,
you already an idea. But I think it's in the tens of thousands.
right.
But they also help you build out the model. They do a whole.
Mm,
It's like a more of a software and a consulting service
okay.
rather than just a play around with it as you will, because the platform is quite techy. Like
Yeah,
it's
if you're
actually yeah,
getting consulting services as part of it,
yeah.
like 100 hours or 200 hours a year of consulting,
Well, it's a
even at
one off. I
40,
think it's
50,000 a
yeah,
year, that can be pretty compelling for even
yeah, yeah.
mid-sized businesses.
Yeah, well, it's a South African company, so it's not American prices, I think, first off, but also
Mm.
it's not per year. I think it's consulting to set it up, and then afterwards there might be some
Oh,
maintenance afterwards.
sure.
It's like I think if I remember correctly, they have the price for the license and then a
Mhm.
separate price for building it, but they sort of price it in such a way to make it attractive, because yeah, obviously they want business, and I've been in talks with them about creating a more mid-market version of it.
Right.
So there might be something coming out of that in the next couple of months, but I don't want to be
The
held to one because I haven't
yeah,
spoken to them
trying to
about
sell
it.
them on being the Canva of uncertainty and
Yeah, I mean, they basically saw
data
causal
modeling.
coming up, and they were like, "What do we do to sort of find the middle ground between
Hmm.
us?" Yeah,
Yeah, right. Okay. So this is fantastic. I feel like at the very least, Causal, go take a stab. It's not hard, guys. Hey,
cool.
John, that's cool.
That's
What's
good
your
to hear.
GitHub? Um,
Nice.
Go check it. I've also built some stuff. It's probably not as nice as John's. Mine may or may not be written in COBOL. And I think a lot of us have, right? This is a space that has been underserved for a long time, and people have been building their own tooling for a long time.
Yeah, and even I've built a couple of like demos and causal that I've put on my website for people just to get an understanding of how to use risk in a business perspective. So there's lots of different things you can do. Yeah.
Can you throw one? Throw your favorite one in the chat.
I'm
gonna go check out John's GitHub here in a minute. But hey, folks, if here are the 3 that Raphael is recommending today. Dip your toe in. I think this is worth a fun weekend project or a Friday afternoon dabbling. Even if you're the CFO, I think there might be value for you. Quantitative analysis, managing by metrics.
How do I put it in the chat?
You know.
Where's the? I've only got the private chat at the bottom. Where's the chat for everyone?
Raphael has technical challenges. Anyway, if we have missed one, please let us know. This is a burgeoning field. This is a field that's moving fast, and there's probably some that we're not aware of.
No, there's definitely. I mean, these are the ones that. I mean, I get approached by a lot of companies asking me to sort of test out their software. So I've seen a lot of different things that are sort of starting out, but I haven't played around with like dozens of existing tools that have been around. I mean, I've played around with a couple of them, but sort of I found a couple that I keep testing out new ones to see whether they're sort of competitive. I've been mostly disappointed with them, and so I've stuck to what I like because it does what I want really, really, really well. I'm sure there are other tools out there, but I've spoken a lot about risk analysis to a lot of different people. I've never been told of a tool that comes even close to what Causal can do at the price point that it does it at. So, I mean, if there are other tools out there, I'd love to hear about them.
I haven't. Please tell us, folks.
So,
all right, we are a little over our slot, but this has been a really fun one.
I've put my link in the private chat. I don't know if you can put it out in the public one because I can't see an option for that anywhere on my end.
Help, tech people, help!
It's weird.
Okay, have a wonderful week, folks.
Yeah.
And if you do manage to create something cool, please let us know. We'd love to talk about it. All right.
Thanks,
see y'all later.
Thanks.